I'm Charlie Gasparino from Fox Business and Fox News and the New York Post. Welcome to another riveting edition of Risk and Return. My partner in crime, the granddaddy of data, Bob Sloan, is out today. Probably trolling for some more data for S3's archives. We got his trusty assistant, Sam, here. Sam Pierson. What do you do at S3, Sam?
I'm on the research team, so I do research. We do writing. We put out content, longer form blog content. We do some of the content for the podcast is one of the things that we look at.
And you have in Bob's absence today, you do have actionable calls. You have some of the stuff from some of how we did from last week. I'm gonna briefly go through some headlines that I'm looking at today, and then we're gonna get right into it because we have viewers that are hungry for data and for information and for stock trading advice, or at least not advice, but stock trading data. And you make up your own mind on what to do with it. But S3 is the number one independent data provider on the Bloomberg platform. It earned that status for a reason because its stuff is really good and people kill for this data, and we're here giving it to you, for free, so to speak. Or at least not really for free, because then you have to listen to me, which is like paying. You have to go through a degree of pain. But in any event, before we get to that the S3 stuff, couple of things I'm looking at, Sam. Number one, Kevin Warsh, his triple mandate is something that everybody should pay attention to. Not only does he have to deal with inflation as the next Fed chair, not only does he have to do it within the context of employment, keeping employment matters in check, but also he has to deal with Donald Trump. And this is the sort of $64,000 question in Washington. Just is Trump going to be turning the screws on him to lower interest rates immediately, short-term interest rates? Is what he has the most power over the Fed funds rate, as Trump wants, or is he going to give him some leeway? As you know, it's really difficult to lower rates right now. One reason is that we still have hot inflation prints. We have a war in Iran, conflict in Iran. Oil remains near $100 a barrel. We do have inflation right now, so that's one issue that I'm telling you everybody's talking about. My guess is that Trump has to cut him some. It can't be this tone deaf not to cut him some room to get through, his initial baptism by fire. He's got a divided Fed. It's going to be hard to get consensus. I think he gives him a little running room, but we'll see what happens there. The other thing I'm looking at is, Zohran Mamdani, our socialist mayor here in New York City, has become a national story because he's like the darling of the Democratic Party, an avowed socialist. Some would say Marxist because of his prior comments, someone that's sort of radicalized in third worldism. It's kind of an interesting spectacle. He's meeting with CEOs now. The last couple of weeks, he's been meeting with various CEOs of Bank of America, of Blackstone, you name it. Yesterday, he met with two of the biggest, Jamie Dimon, head of Megabank, JP Morgan Chase, and David Solomon, the head of the prestigious investment bank, Goldman Sachs. What's interesting about these meetings were sort of prompted by his attacks on the business community, including a really personalized and I would say distasteful attack against Ken Griffin. Listen, I don't get up every day, Sam, and think, how am I going to protect billionaires from political outrage that they make a lot of money or they need to be taxed. But it's not just the taxing of Ken Griffin that Zohran Mamdani did. I mean, he proposed a petit tax. That's a tax on second homes worth more than $5 million of people who live out of state. But more than that, he personalized it. He went in front of the guy's penthouse, did a social media spot, and in many ways tried to make Ken Griffin this sort of poster child in this really toxic political environment where there is violence that goes on when you start singling out certain people. And and Ken Griffin mentioned that at Milken when he addressed the issue. He said the spot, when he looked at it, he watched it 3 times. First it was creepy, then it was weird, and then it was frightening because we all know what happened to the United Healthcare CEO. There is this sort of left-wing impulse right now to take matters in your own hand and go after CEOs and go after wealth producers they think are inherently evil. It's a sick ideology. It harkens back to what went on during in the 60s and 70s. The Weather Underground, the Black Panthers, you name it. It's also morally corrupt. Mondami kind of fed into that. What was interesting about the meetings, at least with Dimon and Solomon,
Yeah, I
they did
saw I
not
saw
mention
that
Ken Griffin. It was a very chummy meeting.
that you had that. Yeah, yeah, yeah. I saw that. So what do you make of that?
So the meetings were set up following. Remember, his social media spot went viral actually, and I think it was in sometime in April, and then the New York City Partnership, which is the business advocacy group in New York City, reached out to the mayor's office, and then that's when Mondami started, talking to the business community because he knew he had a problem. Business people were threatening to leave. It was getting really there was outrage. Now you have him against the ropes, and what do? You invite him over, or you go to his place. Solomon went to Gracie Mansion. Diamond invited Mondami to J.P. Morgan headquarters, and you kind of like roll out the red carpet and be really nice to him. And I'm not saying you have to scream at the guy, but you got to like set some boundaries. And the fact is, Ken Griffin's name didn't come up once. But in any event, I did a story that they, based on the commentary I got from the firms today, they weren't too happy about, where I called them to the carpet on it. And I think rightfully so. I mean, you got to set boundaries. Like I said, you don't have to curse and scream at the guy, but you got to tell him, listen, what you did to Ken Griffin was wrong. Try to take this down. This is a bad environment. Who pays the bills here? Listen, New York City is a welfare state. Zohar Mandami makes it sound like it's just a bunch of rich people running around fleecing the poor and the working class. That's not the case. I mean, we subsidize everything for poor people here. If anybody gets squeezed here, it's working class people who, because of this massive welfare state and the fact that there's rich people here, poor people that are being subsidized by the rich, the middle class gets squeezed. And be that as it may, no one kind of went there with him. They were talking about public-private partnerships, how we have to all work together. Yeah, I mean, you don't work with Marxists. I mean, it's okay to have a cordial relationship with him, but I think Jamie and Solomon have to draw a line in the sand and say enough's enough. This is a guy that's not just your run-of-the-mill Democrat. We're not talking about Andrew Cuomo here. We're not talking about Barney Frank, who just recently passed, a long time, liberal congressman who dealt with the financial sector for years because he was on the House Financial Services Committee. The Dodd-Frank reform bill is named after him. We're talking about someone very radical and very left wing and very third worldish. If his attacks on America, his refusal to criticize from the river to the sea, flipping the bird at Columbus statue, you name it, it goes down the list. So, being nice to him, I don't think is going to help your cause or help anybody. As a matter of fact, I think it's going to make it worse. And I think the business community has been being nice to radicals in New York, running New York politics for way too long. And it's about time they stop. So I pointed that out in the story. We should point out that, for all, oil came down today, which is interesting. The markets are up. What's so weird about this whole dance between oils and markets, and it's all over something that Trump says. At some point, it makes no sense because we're every other day we get a different story on Iran, and I think it's incumbent on the president to like just do it or not. Like let's get out of there, or let's bomb them to kingdom come, because this sort of this sort of like purgatory that we're in right now, I don't think is doing him any good. It's not doing Republicans' chances in the midterms any good. And the oil came down today. It's below 100, but I think I saw it 97, but it's still high, and gas prices are still up. And
Yeah,
this
and it's interesting on the On the short side, so we've seen just a little bit of shorting coming in on the margin,
Right.
but really not very much. And there had been a lot of short covering as kind of getting out of the way during the big rally, and we really haven't seen much of a re-engagement. So like a bet, that oil prices are going to kind of keep coming
I mean,
back
no,
down. We just
but
haven't
Sam,
really
no
seen
one
that.
knows where this is going. I mean, that's one of the problems here with playing this. It is just like, and we could be at war tomorrow, today, 1 minute, and then literally Trump will change his mind. Oh, we have a breakthrough, and it's not really a breakthrough. I mean, how many times have we had breakthroughs? Serious negotiations. So it's getting a little annoying now. So you kind of feel this sort of weight on the markets with this ridiculous waiting game that we're playing here. So at some point he's going to just say enough's enough. And my guess is he doesn't get out. I guess if you were going to be a betting person, what would he do first? End it, like leave, and get out of the conflict, or bomb them to kingdom come. If you're betting, and this is one of the problems with playing the oil markets right now, is you got to it's got to weigh towards the bombing. That sounds like something Trump would do. So anyway, that's where I am with news right now. It's kind of an
Yeah, I think
interesting
it's
week. It's
Yeah, it's kind of interesting on the oil price, similar to what we're seeing in rates, where we've seen this big move in long duration rates, and maybe that would seem like a bigger risk to the market, except maybe people are sort of looking through it, like thinking that we're going to get through this conflict, we'll see oil prices come back down. And maybe there'll be a resolution. So maybe something, a kind of a similar thought process there, where because of the inflation, they're not going to be able to lower rates. Kind of seems like the impression now. And I thought the comments yesterday from Trump were really interesting, where after all the browbeating of Powell over his rates, when he gets asked about Warsh, and he's got like well, basically says he'll figure it out, and he's kind of blasé about the whole thing, which I thought was kind of funny. Maybe trolling a little bit. The next guy comes in and you just sort of say, he'll figure it out. Yeah, I don't know, just that seems like kind of a funny statement, or
well,
a
he's
funny way of putting it.
Warsh is in a really difficult spot right now. He wants to cut rates, he can't. It's just he doesn't have consensus to do it. The Fed is generally a consensus-driven agency. It's a central bank. It's a rough spot, and even if he wanted to cut rates, and you just can't do it now with this thing going on and with oil at near 100. So the only thing I could say is that the economy, the doomsday on the economy, is not happening. People were like, this is going to destroy the economy. Inflation is going to go through. I mean, we have inflation. It's not through the roof. I mean, I lived in the 70s. This is nothing compared to the 70s. We've had $200 barrel oil under Joe Biden when Russia invaded Ukraine, and when ESG was kicking in because the Biden administration was obsessed with everything, left wing social and economic policy. So we don't have that right now. We are drilling a lot. So I kind of think if they can get this behind them at some point, listen, maybe I hate to say it, because I don't want people to die, but maybe reduce the place to rubble and leave. What's left? Then they don't have anything left there to terrorize the world with. So that
And
might
and
be
it,
the answer. I
it
don't know. I'm not a military strategist.
yeah, it does seem like there has to be some looking through it, right? By the markets, where you just say,
But here's the thing. It's
doesn't it freak you out a little bit, right? With inflation coming
it's
back,
so
and
obvious
you're
that
looking
the
through
Iranians are
it.
playing a long game and stringing him along, meaning the president, and saying like, oh, you know, fuck you 1 minute, and then let's talk the next minute, and then throwing a drone at UAE or something, So it's clear they're playing a game, this sort of cat and mouse game, and it's getting like tiring at this point. So, and I got to think that Trump is like saying, excuse me. It's been a long day, up early writing.
Yeah, no, we've been
um,
seeing the results of that pavement pounding in
that's
the
all I've been
post
doing
all
is
week.
writing and up early. Yeah, but you got to get the feeling that he's at his wits end. But we'll see. Again, it just keeps going around and around and around, and I don't think it's good to let this thing fester. But in any event, let's turn to some of your stuff, Sam. What do we have actionable stuff this week?
Yes, so we have a few. We have one to catch up on from last week, which is RBC Bearings. That was a bullish call, which was incorrect. The stock was down after reporting, so that is 0 for 1 last week. But we do have 3 new picks for this week. First up is Williams-Sonoma. They're the $20 billion furnishings retailer. They obviously have the Williams-Sonoma brand in addition to West Elm and Pottery Barn. The price was down 4% year to date into the report, and short interest was down 17%. They report Thursday morning, and the model is bearish. Next up is another retailer. We have Walmart, obviously one of the biggest retailers. They have price up 20% year to date. Short interest is up 22%, and they also report Thursday morning, and the model is also bearish on that. Finally, as far as new models go, new model calls go for this week, we have BJ's Wholesale Club. They're the warehouse club retailer. Similar to Costco, the price is up 8% year to date, and short interest is down 14%. They report Friday morning, and the model is also bearish on that. So 3 bearish calls coming this week out of the S3 earnings model.
Go ahead. I cut you off by accident. Go ahead.
Okay, yeah. So shifting gears here a little bit, we'll go into a couple of the commentary pieces we wanted to look at, starting with the inside the buy side, looking at U.S. semi stocks. And so what we're looking at with the U.S. semi stocks in this first slide are the names where these are the top short interest as a percent of float Z scores. So this is cut off only to look at the names where the short interest as a percent of float is 1 standard deviation above its 1-year average. And so you can see on the top of that list, Micron, Qualcomm, and NVIDIA are the 3 stocks that are at the top. So exceptional levels of short interest as compared with their historical short interest and volatility.
Now, the NVIDIA is a function of hedging, you think, right?
I mean, it's certainly part of it. It's going to be, there's going to be a few things. So certainly there'll be some hedge, some directional short, some hedge in the sense of like funding shorts in a portfolio context, or a hedge in the short of just being, one of the largest stocks. So if you're short, the NASDAQ ETF or the S&P 500, you're effectively shorting some of those, the largest market caps as a part of that. And so they just reported earnings. It seems like the initial reaction is down a little, which is interesting. We published a note yesterday. My colleague, Matt Unterman, looking at one of the interesting things was the option implied move. Expecting a larger move, greater than 5% implied. And so we'll see, we'll get more details tomorrow. But so far in the after hours, it looks like it was down 50 bips, maybe up 50 bips.
So they just reported, NVIDIA just reported today, you're saying?
Yep, exactly. Yeah, so after the close just now. So an interesting signal for the market, I think possibly one where maybe some of the option market makers will be the winners, right? Where you have a really big implied move, and then there is a realized move that suggests a lot of option premium that's expiring worthless. So there may have been the hedges on both sides, whether you're long or short, kind of not wanting to be exposed into the print. And that's kind of what the reaction looks like so far. So it looks like revenue you're down a little, but so shifting back to looking at the slides, if we look at the next one where we're the semi shorts holding into the rally, So the point we're making here at this point, and this is one of the things S3 clients really get into, using the Bloomberg terminal, where you can aggregate this data really easily. And so we have the short interest in aggregate for the semiconductor index reflected a couple different ways on the blue line. It's equally weighted. And then on the black line, it is weighted by the dollar value of the shorts. So the black line is showing more weighting towards those stocks with the larger notional short positions. And so the point is that we've seen covering during the rally in semis across the sector, but only if you're looking at the simple average. So this is a large number of stocks that in this sector that saw short covering, but the biggest stocks didn't. Right, so that's kind of what we're looking at, with like Qualcomm or Intel. I mean, Intel's been a little bit of
Why
short
is
covering from the peak.
is that because this is again a hedge? These are stocks that you, instead of shorting the market for a hedge, you short these big tech names.
Yeah, I mean, I think there's a variety of pieces. One of them might be in terms of derivative exposure. Maybe there's some asymmetry that investor could buy puts that seems like the safer part of the bet. So you're kind of long the riskier part, and you're sort of, as long as the music keeps going, I'm long this thing that maybe I'll outperform. And then maybe you're short something like you're short something like in an asymmetric way, like on NVIDIA, so that if the market rolls over, you'd make more than you would lose on the kind of more speculative long that you'd have. Yeah. So something along those lines, could be a part of it as well. And maybe in some of the smaller semi stocks, there's kind of more of a disconnect possible from fundamentals, and that was kind of what you saw with more short covering there in April, and we'll see similar or kind of a portrait of some challenges for Qualcomm on the short side in just a second. Yeah, and so one of the things we wanted to look at on the positioning side, just to give a sense of scale, we're looking at the passive in blue, the active long in green, and the hedge fund long in gray, and the notional short in black. So there's 6.7 trillion in passive longs in the market. Active is just under 2 trillion, and then hedge funds about 300 billion, and short interest about 200 billion in U.S. semi stocks. So as we're kind of looking at some challenges on the short side, the hedge funds are still more long than they are short, by a margin in the semi space. And so there's they've pressed some of the shorts in some of the large caps, like we noted, and then also obviously some of the more shorted stocks have outperformed, like we've seen in stocks like Qualcomm that we'll go to in just a minute. And NVIDIA, as we mentioned, that they're reported the largest market cap, and they're about 1.2% of the float short there. So kind of par for the course a little bit on just being one of
NVIDIA, by the way, NVIDIA is in the middle of everything. The shorts, the longs.
Yeah. I mean, it's kind of a market bellwether. It's very central to obviously to this AI build out, and so we often look at CoreWeave as kind of being a sort of indicator of what's going on with the NVIDIA business model, and NVIDIA is an indicator of what's going on just with the whole AI build out. And so, definitely central in a lot of conversations that we have about how people are positioning in the market. And shifting to zoom in a little on Qualcomm, that's an interesting one. And as I was alluding to, a little bit of a portrait of pain on the short side. The shorts had been up substantially, so this really sold off in March. Along while the software stocks were really getting hit. And so in early April at the peak, shorts were up 1.7 billion year to date in Qualcomm, and now about 6 weeks later, they're down 1.8 billion. So a total reversal there. In Qualcomm's, so that's a $3.5 billion swing on the short side. So there may have been a little, more of a fundamental short there. And they caused some of the really large increase in shorts earlier this year. And yes, so one more thing I wanted to talk about, just one of our favorite things to go through are the Battleground stocks. And so there's one narrative here that I wanted to mention in particular. And so I think it's always worth looking at the list. But one of the points that's interesting to break down a little bit is the column that we have that shows convertible bond or convertible arbitrage exposure. And so there's a column that shows an estimate.
Let's unpack this because not everybody understands what that means. And by the way, I kind of know what it means. I don't really know what it means, but go ahead.
Sure. One of the securities, if your firm's raising money, that you could issue is a convertible bond. And so that can be appealing to investors for a variety of reasons.
Which converts into stock at some later.
Right. Yep. So you're basically being given a call option with the bond that is that that converts at a higher price. And so you're giving, as the issuer, you're including a call option when you sell the bond, and you're doing that because then the buyer will accept a lower interest rate. So maybe if you just sell this as a straight bond, you'd have to pay 5%. But if you sell a convertible, maybe you only pay 2% or something along those lines. And so, from an investor's perspective, where you could just be long convertible bonds, right? Like you could go buy a convertible bond fund, and that's a distinct asset class. But a hedge fund strategy, a popular hedge fund strategy, is convertible arbitrage, where you're basically on the way into the trade, the funds are trying to buy volatility for cheap, and so then hopefully being able to buy that volatility for cheap, then they're hoping that volatility will increase, hopefully with the price going up, and then they would benefit from owning that call option. And so over the course of time, the idea is that the price goes up and your bond is sort of trading more and more like the stock it could be converted into. And so you're sort of short more and more shares on the way up to stay hedged up until the point where the bond is deep in the money, or that call is deep in the money, is basically trading like stock. And so at that point, you would have shorted all of the shares that the bond could be converted into. And so let's say that happens and then the price drops by 5%. Now you don't need to be short as many shares. And so you cover that profitable short trade. And so trading is the actual strategies around doing this are really complex. So these are
this is high level trading stratagem,
right. Yeah. So I'm describing this at a high level, but to go actually do it is another thing entirely. But this is a place where S3 data is really essential for those market participants who need to have a high degree of clarity on borrow availability and rates and potential pressures on the short side. And so one of the really great ways we can do that is via the Bloomberg terminal, where we can provide using the convertible bond data from Bloomberg alongside the daily short interest data from S3, and really create a compelling picture of what's going on in terms of positioning, something you can quickly look at and get an estimate of kind of what's behind the headline short interest number. And so that's the kind of thing that we're really focused on with helping clients understand not just the kind of high level that you might get somewhere else, but kind of what's going on underneath and what's driving those figures that you might see in the headlines. One of the interesting things is when we look at some of the times when there's been significant outperformance by the most shorted stocks. Often some of the most shorted stocks with convertibles, they'll outperform by the most. Right. And so, it can be a really explosive combo, and they kind of get some, a kind of a meme-ish, like Open Door, or like or MicroStrategy, when the converts were a big part of their capital structure. Tesla famously, and so it's one of the things that happens when they issue these convertible bonds. The issuer will often go buy a big call option from the brokers who arrange the deal. So let's say they raise $1 billion, they might spend $100 million on call options to hedge the dilution. So they want to make the converts attractive to the buyers, so they'll have like a low strike price on the call option, but then they don't want to kind of freak out and dilute their existing shareholders, so they'll buy this call option. And so at that moment, you kind of have this large call option that's been sold by the broker that is, that's out there. And so in addition to, with all the retail trading where maybe we'll see, a lot of short-term option trading in some of those meme stocks, and then it kind of combines with the hedge of this, this kind of large call option related to the converts that's being hedged.
And so how do we find out? So I guess the best question, if you want to dive into this completely complex trade, which when you start breaking it down, it's not as complex as you think. There's a logic here. How do you do that? Find S3 data? Go to S3's website,
Absolutely, yes. So going to S3 Partners website is a great way to get in touch. You'll find us on social media, on Twitter, at S3 Partners. So we're always happy to get in touch there as well. And literally in terms of how it works, the data is available on the Bloomberg terminal via the web. Data feeds, obviously systematic investing is a major source of demand also. So kind of all the flat file deliveries and whatnot. And so looking at the data on the Bloomberg terminal is a great way where we can kind of for this convert use
everything
case.
You ever wanted to know about convertible arbitrage from S3.
Exactly.
S3 Partners data, I should say.
Uh,
an interesting headline that just popped in. I found this kind of interesting. Well, it's a couple. Larry Fink got kind of a cold shoulder from his shareholders on his huge pay package. He's something like a $40 million for 2025, 37.7. If there's anybody that's returned value to shareholders, it's been Larry Fink and BlackRock, particularly the last couple of years. I mean, he's been killing it, on all cylinders, particularly and particularly as he's backed off a lot of that ESG stuff. So I don't quite understand that. It's maybe it's a trend. I don't know that shareholders hate it now than when CEOs perform and they don't want to pay them, but something to keep an eye on. And I found that to be interesting when I saw that headline, because if there was one guy that performed really well, it's him. Another thing is, this isn't just in the journal just now. Fed minutes reveal support for rate hikes. So that kind of gets to what we were saying before. It's kind of like they're not going to cut rate. They're not going to cut rates. If anything, they're going to raise rates. I mean, and Kevin Warsh, by the way, he's got evidence to raise rates if he has to. I wonder if he does raise rates, though. That to me seems like he's not going to do that. If he does anything, he stands pat. That's what I think he'll seek consensus for standing pat.
Yeah, I mean, I think if the equity market continues to just kind of go higher, I mean, maybe there's that kind of populist outrage. You kind of see that scenario.
Yeah.
Where markets are really high, maybe the Nasdaq goes up to being 30% up this year, and prices are going crazy, and AI is freaking people out, and people are out in the streets again, on prices, and but I mean, it seems like we're expecting inflation. And we see those expectations through rates, but it just doesn't seem like a market trading under the expectation there's going to be big heights or kind of another big leg up in inflation.
Yeah, I agree. And just one headline on a story that I've stayed away from, but I almost feel compelled to talk about because everybody on Wall Street's talking about this whole thing with the JP Morgan banker and his supervisor, Lorna Hagini. The banker's name is Rana, Rana Shirayu, I think. Rana. He says that she sexually, she accused him of sexual assault.
I saw that. It's interesting. I saw that the defamation.
Right. So I don't know a person in on Wall Street that believes Mr. Rana. Mr. Did I say his name? Raya?
Yeah. I think
Rana. I don't know anybody who believes him. They look at the pictures of both of them and say that doesn't make sense. Now, not that means anything.
Yeah, I mean, I don't think that. You know,
It's not,
it's like the
but
lone
the
indicator.
evidence. JP Morgan says it's not true. But she's now sued him for libel for destroying her life. And I can tell you, this thing shook JP Morgan. I was in doing my diamond coverage yesterday. I was speaking with the people over at JP Morgan about this lawsuit, and you know, they really feel sorry for this woman because her life has been like turned upside down. And maybe this is the story in the social media era. The you're if you could say something is outrageous, whether it's true or not. Like I said, they say it's not true. A lot of people are doubtful that what Mr. Rain is saying is true. But whether it's true or not, let's just say it's not true. Okay, just for the sake of argument, this woman's name has been plastered all over social media. There are memes of her. I mean, if this is not true, which, like I said, J.P. Morgan says there's no evidence, on and on. I mean, you would think she's got a case for damages, just because this took such a life of its own. Just because we don't have to get into all the sordid details, but there was some really sordid details.
Yeah, and it's kind of it's kind of a perfect like social media thing, right? Like everybody is so ready apparently for this kind of story or something along those lines. And we saw what happened with Vrabel or with that random couple that was at the Coldplay concert. It's just for the social media for whatever reason is so ready for that kind of story. And as something like that comes out, it just blazes. But if you put somebody else in that position for no reason,
whether it's true or not, and that's the problem. One of the things
allegedly
about risk and return, that's why we're covering this as a step back. What does it mean as opposed to the story itself? We try to stick to the facts here. You know what I'm saying? We cover real stuff. I mean, real trading, a real challenge for the Fed chair, a real meeting between Dimon and Zohran Mamdani. I bring up this because it kind of speaks to the sort of weirdness of our of society now with social media, and just how whether it's and you see it involved, it impacts finance and it impacts the stock market. I mean, meme stocks were about a notion that hedge funds, maybe on Mars, were manipulating stocks, and through dark pools of liquidity. And if you want to fight back against the hedge funds, you should buy these stocks and make life miserable for these rich guys. And maybe it worked for like a week, or a month or a couple of months, but in the end, all those meme stocks, or most of them, have fallen back down to earth. Except for GME hasn't, only because the guy that came in, Ryan Cohen, kind of fixed the company, and he diluted the shareholders, which led to the stock declining way off its highs. But the company's now sitting on cash. It's not a company that's going out of business.
And some interesting things that have been happening, with collectibles have been going crazy, and anybody's in like baseball cards and all that stuff, and so GameStop is kind of.
I used to be, by the way.
Yeah, they've gotten a little bit involved on grading cards and things like that.
When I was a kid, I used to collect When I was a kid, I used to collect.
You have a stash. You got the old basement stash.
I do have. I still have a little stash of old baseball cards.
Oh, all right.
And maybe it's worth something now. We should.
I love it. All right. I'm trying. Okay, so I have quick before we go. I have one more that I wanted to look at. That was one of the Battleground stocks, Wendy's. So it's an interesting stock. It's there's been some.
What'd you say, Wendy's?
Yes. Yep. Yep. That's right. Yep. Exactly. And so it is a QSR, which is a quick service restaurant. So don't call them fast food.
Oh, okay.
And so quick service restaurant, or fast casual. These, but yeah. So one of the interesting things with Wendy's is the short interest just screaming higher. And so it's almost doubled this year. And then last week there was a rumor that Nelson Peltz, who owns 16% of the company, already was considering potential take private. And so we already saw a take private earlier this year with Denny's. There's been some rumors around Papa John's. And so with with Wendy's, it's interesting. There's this large short position, and it's continued to increase over the last week. So we didn't really see a lot of any net covering, even though the price jumped about 17% on the article dropping last week that revealed that potential kind of buyout narrative emerging. So they have a larger enterprise value. There would be more in the 4 to 5 billion area, so about double the size of Papa John's enterprise value if there was gonna be a deal. And so and a similar thing, one of the interesting things to look at is looking at the long to short ratio for Wendy's. And so we see an interesting thing here with the short interest trending higher and kind of coming up to meet the active long interest. And it's something you want if you're going to be in a trade. That there's somebody active on the other side, who might sell, right? That if you're right, there's somebody
Now
there to
the
sell.
short play here is the deal doesn't happen, right?
Right. Yeah. I mean, I think that that's got to be kind of the viewpoint is that that this isn't that the things that have been headwinds for them on food input costs, for example, that those issues are going to persist, and that there isn't going to be
And Nelson is snooping around buying it to.
So he's already a large shareholder. So he already owns 16% of the firm, but it does feed into the kind of battleground status a little bit, with the idea being, he's kind of saying, maybe he'll do a take private, or maybe he would, potentially, get out of the stock. So I think
Nelson, by the way, Nelson Peltz is generally the way he operates is positive engagement with management, trying to get them to fix their balance sheet. That's what he's done with every single one, including GE. When he got it, I covered his foray into GE, which included trying to get rid of Jeff Immelt. And I wrote that story, as a matter of fact, and I made Jeff Immelt's book because of that. But on his travails as the CEO of GE post Jack Welch. And as you know, GE right now is a shell of itself. It's broken up. It's sold various pieces. I wonder if GE will ever become a battleground stock again. We should probably. That's probably good for next week's show.
Yeah.
Get it.
That's funny. I had a cousin who worked at GE Capital during the heydays. There was some heydays.
Oh yeah. All right. Well, let's leave it there, Sam. That was a great show. Thanks for filling in for Bob. The granddaddy of data is out forging data. And will he be back next week?
Yes, I believe so.
Okay, so we'll see Bob next week. Again, Charlie Gasparino here for Fox Business, the New York Post, Fox News, with Sam Pierson of S3 Partners filling in for the granddaddy of data, Bob Sloan. Thanks for watching. See you next week.